Good morning, everyone. Welcome to Officer 24/7. My name is Niharika Walia Bhatnagar, and I'm with you with the area of ABFM. Another day, another session for the area of Module C. As I told you, we were covering the area of Module C. In the previous classes, we have covered a major part of Module C, but a little part is still left. So, we'll be continuing with Module C today as well. Chaliye, everyone, is there any doubt till now? We have done a lot of portions. I think tomorrow we'll be taking up module D, and on 7th we are having our main marathon. Before I proceed further, please share this session among your peers. Everybody, please share the session. Chaliye, then let's begin, everyone. In today's session, we were done with the topic of corporate valuation, which was the first chapter. Then we were done with discounted, and I was discussing the other discounted val this other non-discounted cash flow method. So I'll be starting with that particular method itself. ठीक है? चलिए, then let's switch on to that specific area itself. Here comes the first question, everyone. What is the purpose of determining the multiples used in valuation in relative valuation? It is to compare the financial data of different companies, to identify comparable business, to calculate enterprise value, or to provide results suitable for the task at hand. What would be the answer? What is the purpose of determining the multiples used in valuation? Why do we determine the multiples in valuation there? Okay. When we talk about relative valuation, as I told you, relative means compare. You are looking at your organization, you are looking at other organization. So best is when we are looking forward to different valuations, that is to provide a suitable results, to provide results suitable for the task in hand. We have to give results. So it is always better that you are getting first-hand information from multiple areas rather than one specific area. Okay? Then comes what is the PE multiple? Acha everyone, there are 2-3 multiples in this area. I hope you know that. First is PE, price earnings. Then we have PB, price book value. Then was one more, PS, price and sales. Then we have PEG. Okay, all these are covered in this particular module itself, in the module C. This was the third chapter, other non-discounted method. It has got many of these. Okay, so we are looking at first one. So go ahead and answer. Is it enterprise value multiple or EV upon EBI TDA divided by sales? And then the second one is the area of equity valuation multiple, that is PE, that is uh, market price per share divided by earnings, and then is book value multiple, that is book value is total equity upon total assets, and the last one is sale valuation multiple. What would be the answer according to you, everyone? The sale value multiple or EV upon EBI TDA. Okay. Now what would be the answer? In this case, the correct answer is when we talk about equity valuation multiple. In this case, PE is for equity valuation not the enterprise. And in this area is PE. Since it is talking about PE only, na, it is MPS upon EPS. The market price. In fact, look at this particular P upon E. This P is market price and this is your earning per share. So the correct answer is MPS upon EPS. How is the value of the subject company determined in relative valuation? By applying average multiples of comparable companies to its financial attributes by using discounted cash flow value calculations, or by analyzing historical pricing uh, trends, or by comparing its market capitalization with industry average. How is the value of the subject company determined in relative valuation? What would be the answer, everyone? Subject company, we are looking at we are looking at one specific company, okay? And we are asking how can we find the value of it. The simplest way is you have one company A, one company B. No one would be the same company. If I say Coke and Pepsi are the same, you will say no, ma'am. PepsiCo has got so many other products as well. Coke is also working into another field of the the kind of people they are catering are also different. Pepsi is into the area of all the showrooms and outlets are having Pepsi fountains. While when we talk about Coke, Coke doesn't reach out to these areas, but Coke is something which you will find even in the most rural area of our country. You know, so Coke is still there. Coke has made its reach to the most rural grounds of our country. It is now right now even available with the radar people as well. The people who are carrying all these things in radars. Radars are basically those bicycle carts and all which they are carrying in those specific rural areas, and they are selling all their things on the go, or they are selling it online. But they are selling it completely through those physical modes of bicycles and those specific go-kart kind of thing which they are using, right? Those carts which they are using, and they are having Coke. That means Coke's reach is way more than anything else. So that means we cannot compare these two companies, but we'll still compare. Why? Coke and Pepsi are both old companies, and at the same time both the companies are into beverages. That makes them comparable. So in this case we cannot have same identical companies because no companies are same. But yes, in this case, what we have is multiple average multiples of comparable companies by applying average multiples of comparable companies to its financial attributes. Acha, here comes PB, that is the price and the book value multiple. I've just told you about the name, so I hope the questions that would come after this, you'll be able to catch them out. Acha, everyone, got the answer? Everybody who's in the class, please share the session. On 7th we are going to have our Maha Marathon, in which we'll be meeting at exactly we'll be meeting at around 6 p.m, right? So be there in that particular marathon. We are going to talk about all these concepts in detail in that particular marathon, right? So there are a couple of questions that we deal in that particular almost a 4.5 or 5 hour class. So I hope that would be helpful for you for this examination. In the last attempt, I received good number of people in the class, and I still expect to cross that particular mark this year. So just letting you know, we'll be meeting on 7th in the evening. Okay. Acha, tomorrow as well, the mini marathon is being conducted at the same time. That is, we'll be meeting in the morning for module D specifically. The point is, what is the key advantage of using PB multiple? It considers intangible asset. It is affected by variations in earning per share, or book value is almost always positive, or it accounts to for inflation and technical advancements. Book value is actually a particular area which talks about the financial status of the organization, how They look at the financial statements and find out all the assets and what is the worth of those assets in our books. So in this case, we can say that the book value is almost always positive. It will never be negative. Normally, book value is never in negative. That is why we can say in the key advantages, there will never be a misguiding. In terms of profit, it can be. In terms of earnings, because earnings can go negative. You know? Earnings of the organization at one point of time can be positive or it can be negative even. But book value is normally always positive. So the answer is the book value is almost always positive. In what situations might the PB multiple be more important than PE multiple? In what situations you can say this one would be more important? What would be the answer, everyone? When EPS is extremely high or low, or when considering the intangible assets, or when the market value is more relevant than book value, or what when technical advancements are significant. When we talk about the book value considers both intangible and tangible assets. You know, so technically, when considering intangible assets, it can be taken, but the fact is there where us we have to pick up the situation where it is better than PE multiple. The problem is if the organization is not having stable earning per share. At one point of time it is positive EPS, at the other point of time it is negative EPS. So the book value or the value of the enterprise will change just because there is no stability in this area. So they say that when the EPS is extremely high or extremely low, then this is not worth it. So the answer is A. When the EPS is extremely high or extremely low, then at that point of time, the PB multiple is always better. PB multiple is better. What is the limitation of PB multiple? It doesn't consider intangible asset. It is not affected by variations in long-term average returns. Book value can be negative, or it cannot. It accounts for inflation and technical advancements. To be very honest, you will never find uh, the inflation portion becoming a part of it. Okay. Now, this is one of the points there. And when we talk about the PB multiple, now you will find that in the book they have said that in the book value you do not include the intangible assets. This is wrong in the previous part. You will have to you don't consider overall in the financial statements. So let me tell you there one more point. The financial statements includes both, that is tangible, the ones which you can touch, and intangible. But in this case, the intangibles are not considered in PB multiple. So in this case, it is not helpful. Book value can normally be never negative. In normal cases, it cannot be negative until unless the company has been considered as a very sick unit. Only then the reserves and surplus and share capital together will go negative. That is something that can happen. It is not affected by long-term variations. It is affected. The book value of the organization is based upon its reputation in the market, its overall profitability over the span of time. So this is not a limitation there. Okay, it does get affected, and then it accounts for inflation. None of these account for inflation, but then other than inflation accounting, nobody records the increase or decrease in the price of the things, because if we start recording inflation now, then we'll have to keep on updating the books of accounts every now and then, which is again very time consuming in nature, right? So it doesn't consider the intangible assets. Next question. What does the PS multiple measure, everyone? The relationship between the market price and the EPS, or the ratio of book value to the EPS? and the relationship between stock price and revenue, price per share, and then the difference between the book value and the market value. What will be the answer, everyone? The difference when we talk about price and sales multiple, this is taken the portion of revenue of the organization. So find out the place where in the options you have sales. PS multiple is actually price upon sales. So I think C is the point. They have a relationship between the stock price and the revenue per share. You know? So in this case, the answer has to be PS, price per share, and sale per share. This S stands for sales. S is for sales. So price upon sales is the answer. Chaliye. Now let's move on to the next point. What is the downside of PS multiple? All these multiples have a positive and a negative. That's why these multiples get respect in certain areas, in certain areas they don't. It would vary. It is not influenced by variations. It considers intangible assets such as brand equity. No, they don't. It can be deceiving when significant disparities in the assets are present, or it is not affected by technical advancements. Technical advancements and not affecting. This sounds very uh, different there. This doesn't really happen. You know? When we talk about the area of this PS multiple, it can be more or less deceiving. Why it can be deceiving? Because sometimes there can be difference between what your assets were in the past and what your assets are in today's scenario. So the revaluation is required in order to judge the things properly. That's one of the truths. So the accounting techniques and all aren't wrong in the particular area to calculate all these things. But the point is, whenever we are doing these kind of things, we have to look at the practical applicability of the same as well. That so we can say that in this case it can be deceiving when the significant disparities in assets are present. So at this point of time, any method that you are using with the enterprise, it's gonna affect all the decision making powers, not only of one related area or two, but the entire area altogether. Everyone, now let's look at the next question. The answer is it can be deceiving when significant disparities in the assets are present. Next question. What does EV divided by EBITDA multiple compare? Are these theory questions? Yes. Do you require practical knowledge for this? Definitely a yes. So what would you call this? A numerical question or a theory question? This is where most of the bankers makes mistakes. When you're focusing too much on the theory now, then the practical portion of it is something which gets affected. It is market value of the equity to earnings. It is the multiple compare with market value, and then overall multiple the to earn the respect earnings before tax, depreciation and amortization. Then before the market value of the debt to equity or cash on hand and enterprise value. What would be the answer, everyone? What would be the answer? The cash on the market price, cash on hand and market price, enterprise value, market value of debt to EBITDA, overall market value of the company to earnings before interest, taxes, depreciation and amortization. What would be the answer in this case, everyone? Market value. We're talking about EV, enterprise value. We are finding the value of the organization. In this case, the answer is overall market value of the company. Before earning, before tax, before depreciation and amortization. The answer is here only. Do you know the full form of EBITDA? EBITDA is earnings before interest. First of all is I. First is interest, tax, interest, tax. Just a moment. That is interest. It is earnings before interest, tax. Then we have depreciation. And the last one is amortization. Done. In this case, what are they saying? Whatever the values of these assets are, we would record it in terms of the values which we are getting any earnings before payment of any interest, payment of any tax, payment of any, and then keeping the money aside for the depreciation or amortization. Amortization is also for intangible, for the intangibles, and depreciation is all for the tangibles. So there are two types. Next question, everyone. It says, why is cash deducted from enterprise value when calculating this? Did not keep cash into this. Why? To overstate the multiple, to include the interest income in EBITDA, or to avoid overestimating the multiple due to interest income from cash, or to account for the volatility of FCFF. What would be the answer in this case, everyone? Why is the cash deducted? To overstate the multiple, to include it, to include interest income in EBITDA, then to avoid overestimating the multiple due to interest income, and to account for FCFF, that is free cash flow. The basic reason is whenever we are recording, cash has to be reduced out of it to avoid overestimating the multiple due to interest income and cash, because whatever we are writing in terms of income now, cash, there would be more income on the area of cash as well now. So if you deposit this money to the bank, then there it would multiply. So just to avoid this overstatement, we will go for C. To avoid overestimating the multiple due to interest income from cash. Next is, what is the formula for EV divided by EBIT, everyone? What would be the answer? Market value minus the market value of debt and cash. Equity, from equity we are removing all these. And enterprise value divided by EBI TDA, or EV divided by enterprise value divided by EBIT. Or if we write, then EV upon EBIT instead of EBI TDA. Tax, depreciation and amortization. In some cases they're including it, and in some cases they are not. When we talk about the formula, it is enterprise value divided by what? Earning before interest, depreciation, tax and amortization, or only EBIT? The answer is only EBIT. The answer is D. Earning enterprise value of the organization can be divided by your earning before interest and tax can be calculated EV divided by EBIT. Done, everyone? EV upon EBIT. Acha, this is a question of NPV. Huh? During sensitivity, this was a part of module B. During sensitivity analysis, what is the primary objective of analyzing how changes in each variable affect the NPV of the project? It is to calculate the project duration, to assess the impact on the project formal profitability, to determine the external market conditions, or to identify factors affecting the project's fixed costs. What would be the answer, everyone? Why do we do sensitivity analysis? Sensitivity is also checked in terms of allergies as well. No? So they will inject all those things that you might be allergic of, and if that particular body part swells up, that means you are having the allergy towards it, and we're looking forward towards resistance or the medicines for the same. So in this case, what do we do? If we are trying to have sensitivity analysis of the business, what are we trying to assess? We are trying to look into the area of only and only one thing, to assess the impact of project profitability. What is the impact of each and everything? So then we will be able to find out which particular area is more important or we have to pay more attention to. Okay, na? Which is very, very important. If you do not know about it, the particular area, how to increase that profit, then your working and as well as the entire business is under a threat. What would be the answer in this case, everyone? Acha, next question. Which factor of contributed significantly to the value of early global corporate giants such as General Motors and Standard Oil? Advanced technology, financial derivatives, physical assets and infrastructure, and intellectual property. When we talk about the General Motors, now these organizations were super cool. They had something which most of the organizations just couldn't even dream of. The strongest part of their working was their physical assets and infrastructure which they had got during this era. So General Motors of whatever today it is, GM, whatever we talk about GM in our country today, or at the national and international levels as well, these organizations have got a good quality of the physical assets as well as infrastructure. So that is C, physical assets and infrastructure. Acha, here comes an acha. This is something which we have done already. Next question, everyone. What characterized the value composition of an early public traded company from the Industrial Revolution era? So when we talk about Industrial Revolution, every country has got this. India has faced it later, and then I think if we talk about the English era, it came long back, right? So high reliance is on the intellectual property. Diversification into various industries is possible, primarily driven by financial markets or predominantly tangible assets based. What would be the answer in this case, everyone? When we are trying to find the value composition of early publicly traded company from industrial revolution era, during the industrial revolution, the one of the strongest reasons for their existence was they got new machines. They got crazy about those machines, and that is how they started using those machines to that extent that their production exceeded the supply, and whether they exceeded the demand. So ultimately the suppliers had to struggle a bit. But then when you talk about the industrial revolution area, one of the biggest thing that was driven was predominantly tangible asset based. Point of time it had more value. Such as factories, infrastructure, and natural resources, they had more value. Intellectual property and financial derivatives were not as prominent. Okay, so now they've got a lot of importance in the market, but right at that point of time when it all started, then it was not a part of it. Okay, now comes the next question, everyone. So we were done with this question repeated. What differentiated the value of the early industrial revolution from the modern technology? Reliance on intellectual property, reliance on human capital, integration of financial derivatives, or dependence on the assets. Now, we are talking about the area of what differentiated the value sources of it only. At that point of time, one of the most thing was money. But what was the thing that differentiated the value sources of early industrial revolution? During the period when there was an the revolution, things were very different at that point of time, because this kind of organizations at that point of time worked in a very different method. So at that point of time, one of the basic problems which they had was, if they do not have their physical assets, then they will not feel empowered. So one of the industrialization's major breakthrough was this mechanization of the work. Okay, so that is what I can say. Integration, well, there was a dependence on physical assets at that point of time. So this is where those people dependent upon these, while we never. Right? Physical assets are more important, but now the intellectual property rights are super important. Done? Now let's talk about the next question, everyone. Dependence on physical assets. Now, the next point, everyone. What is a distinguishing characteristic of the cost being classified as the relevant in decision making? The cost is incurred in the past, the cost was renamed, the cost renames constant uh, across alternatives, or the cost is avoidable in nature, and the last one is the cost is affected by the decoration by having this term of decisions being made. The cost is affected by decisions. So everyone, if I take the wrong decision now, then the cost can go up or the cost can go down. Any of these sorts can happen. So the distinguishing the characteristic of the uh, period between, what will be the answer in this case, everyone? What is the distinguishing factor? The distinguishing factor is the cost is affected by the decision being made. Think about it. If I produce or if I ask someone else to provide it to me, the cost will make a difference. The way of working will make a difference. Yeah? So in this case, the cost is affected by the decision being made. Acha, another important topic. The next chapter has started, everyone. An important topic to be asked in the examination. CAPM model. What do you mean by CAPM, everyone? How do you define the term CAPM? Any ideas? That is capital asset pricing model. What is the primary concern regarding the applicability of traditional risk and return models such as CAPM to real estate investments? So real estate investments has been exclusively dynamic. What will be the answer, everyone? Lack of consideration for risk premium, ignoring the importance of beta, or not accounting for non-diversifiable risk associated with the real estate, or D, overemphasis on localized expertise. What would be the answer? When we talk about this area, everyone, CAPM model, the answer is not accounting for non-diversified risk. Do you know the basic formula of CAPM is what exactly? First is we get in terms of CFAPM model, first is RF, that is your risk-free rate of return, plus you write your beta and then you write. What would be the answer in this case, everyone? In this case, they have this particular habit that first of all we have RF plus beta, then we have RM minus RF. What does this mean? Risk-free rate of return is defined, and in this we add up the beta. Beta is basically the multiplying factor, the sensitivity factor which changes in the market. While RM minus RF is the risk premium. See, if I put a lot of hard work in this particular area, I'm risking a lot of things. So that is why they started giving a particular uh, thing that is called risk premium. Now that risk premium sounds interesting to these people. So that is how people are looking forward toward these things. What would be the answer in this case, everyone? Then that is C. You are not accounting for diversifiable risk. There are certain risks which are divisionable. They are into different areas. Rather, risks are of many types. So that is how whatever risk you take, you will get reward over it. Risk premium is always on that. How is non-diversifiable risk quantified in the CAPM model for real estate? Through the calculation of the factors by assessing the variations of returns or using localized expertise or based on the science, on the size of the required investments. How do you find it out, everyone? What will be the answer in this case, everyone? When we talk about the answer to this case is C. This is again regarding CAPM model, but exclusively for the real estate area. So in this case, the correct answer is by assessing the variability of returns. Basically, what happens in these areas now, the amount becomes rising. That's why many people just sell their flats away, whatever they had taken, and then they take the money out of it and they are done with it. So real estate is quite a risky area to work upon, right? Why might real estate investors face challenge in diversifying their portfolio? Why do they face problems? Lack of strategic decision making. This is what they do normally. Then is lacking liability to uh, inability to securitize the rural estate and size of the required investments and the need for requirement which will be then is over reliance on multi-factor model. Never rely on any kind of things because what happens is when you are over relying on certain things, then what can happen is your answer would be lopsided answer. It can be correct, but it can be related only to that specific area. What would be the answer in this case, everyone? The correct answer is the size of the required investment and the local need for localized experience. When we talk about the localized expertise, and then our working becomes way better. It is smooth and functioning as well, because whenever there is a particular investment which needs and the need for localized expertise, so then you ask a particular person of that localized area to take care of all those things there. So yes, it is very important. The CAPM model. Size of the required investments is required because if it is a bigger investment, the risk is more, and if it's a smaller investment, then the risk is less. चलिए, everybody, the ABFM module is ABFM is being completed in the revision batches right now. If you haven't joined the revision batch yet, then kindly join in. We are dealing with a lot of questions and a lot of conceptual working. And for that, what you need to do is just go onto our website. Let me show you where to go exactly. Go on to our website, that is www.adda247.com. Right? Go on to our website. This is where you will find all the details. Go on to the area of JIB and CIB. Look at CIB November 2023 attempt, and this is our English Mahapack, right? So this is sorry, English Parpack revision batches here, and the BRBL batches also there. All the batches which are currently working are specified here. Please go ahead and check it out on our website, on our app for further details, everyone. And hurry up, the time is ticking away. All you can do is, if you want to buy my batch for this examination, click on the area of buy now. Use the code Y541. As soon as you will use the code Y541, you'll get it for 1724.77 only. If you want to buy the entire Mahapack, then for the remaining exams, elective and all, it is also available, right? So there are 100 hours of online classes, live classes that would be there. And then we have 146 test series is also available. And at the same time, we 25 ebooks, 75 videos, all those things are already available for you. So check it out on our website and our app for further details, everyone. The current batch is going on, the time is ticking away. Clear the examination in this attempt itself, because after this, the examination is going to get tougher and tougher. So don't forget to complete and focus on your examination completely. Right? So let's meet up tomorrow for module D, everyone. Thank you.